third technique we have is return on investment or ROI. Return on investment or ROI is another simple method for evaluating the profitability of an investment based on calculating the ratio between the return to the total investment amount. So since it's a ratio, then the ROI expected to be a percentage. And evaluation would be based on which opportunity have a larger or higher percentage. And this is going to be the one we go for, or the more desirable. And of course, a negative percentage, meaning that your investment is losing money and you shouldn't select this option. The formula to calculate ROI is something like that. It's a simple percentage equation. Present value of your investment minus the cost of investment divided by the cost of your investment. We will have an example to explain it in a moment. Our example says that assume that you bought stock shares a year ago with $5,000. And after 1 year, today, these shares now cost $6,250. What is the return on investment of this investment opportunity? By applying this rule, we can divide on the cost of investment. So the present value of investment is the cost of these stock shares nowadays, which is $6,250, minus the cost of investment, what you already paid a year ago to buy the stock, over the same 5,000, which is the cost of investment. This is going to give us 0.25 or 25%. But let's say that 3 years ago, you purchased this same stock shares, $5,000, and nowadays, after 3 years, it costs it worth $8,000. Let's have the return on investment in this case, dividing on, yes, exactly, $5,000, it will give us 0.6, meaning 60%. Let's apply our condition that which one is higher, and this is the most favorable or the more favorable approach to proceed, 25% or 60%. Yes, of course, 60% is higher. This is what you are going to choose. I hope you feel there is something wrong, because yes, we make a mistake. And the mistake is, yes, 60% is more than 25%. No argument or no problem with that. But we got 60% after 3 years and 25% after 1 year. Meaning, if you would like to have a fair and more accurate comparison, we should compare about the two return on investment after the same period, after 3 years or after 1 year. So what we are going to do right now is to recalculate the 3 years rate of return, but after 1 year. So it will look something like that. We divide 60% over 3, giving us 20%. This is the new result, and this is the most or the more accurate result. After 1 year, you got 25%, or after another 1 year, you got 20%. Which one you should go for? Of course, the first one is going to be the actual more profitable investment. This shows us one of the limitations of return on investment method, and also this method doesn't take into consideration TVM or time value of money. 5,000 you paid today, a year ago is worth less than 5,000 you paid 3 years ago in the second investment. The more you go back in time, the more value this 5,000 may worth in the past compared by the present value. So paying $5,000 $3 years ago, buying the stock, it's not really the same thing like paying $5,000 a year ago.